Hello everyone, thank you for watching. This is Greg here, and today when we were scanning for positions out there, we found something quite interesting here. So let's talk about this position here. So this is a huge complex position coming from one trader, the same trader, most likely an institutional trader. And we have two short put positions right here at 335 and 300, and also two long put positions at 325 and 290. And same on the call side, we have two short call positions at 385 and 415. And two long call positions at 395 and 425. So essentially these are two iron condors here from the same trader, and sometimes we call this double iron condor or a layered iron condor. It's not a very common strategy that we see every day, and I thought this is interesting, so I wanted to make a video about it. So why do some traders or institutions use this type of strategy? So if we look at this setup here, so essentially this trader is betting that the price will stay within 300 and 415. Not only that it will also stay between 335 and 385. Now, is this trader so confident that Google will stay within these prices in the following weeks? Now, if we look at the chart here, it's certainly possible. And it would make sense from a premium collecting perspective because Google just had a earnings report not too long ago, and implied volatility is still relatively high. So let's go back here and let's look at how powerful or dangerous such a position can be. First of all, both positions and losses are capped. If the price stays within these two condors within the duration of the contract, trader will gain profits from both condors. And same as a regular iron condor position, if the price goes outside of the long legs, in this case 425 or 290, the whole position loses money. But what's interesting with this type of 8-legged strategy is what happens if the price ends up between the two condors. Alright, let's go over different scenarios so that you can see more clearly the pros and cons of this type of strategy. So say in the first condor, the short legs are 0.25 delta and the long legs are 0.15 delta. Let's say that's the first iron condor setup. So roughly speaking, that gives us about a 50% chance that a price finishes between those two short strikes. Now we can only say roughly because right now we can't really see exactly how the position was set up, how much the premium was paid for or collected for these positions, and we couldn't see the delta when the position was set up. So let's say roughly that gives us about 50% chance that a price will finish between those two short strikes. Now that doesn't mean exactly a 50% chance probability of profit, because the premium collected pushes the actual break even a little further out. But 50-50 gives us a pretty good rough picture. Okay, so let's look at the outer condor, the second condor, the bigger, the wider condor. Let's say the short legs are around 0.10 delta and the long legs are around 0.05 delta. So with the short legs all the way out at 0.10 delta, we're looking at a roughly 80% chance that the price will finish between those two outer shorter strikes. So these numbers here will give us a rough estimate of the probability of where the price will end up in. So generally speaking, there's a 50% chance that that price will stay within the first condor short strike. Now in that scenario, that will be great for the trader. Not only does the trader gain profit from this first iron condor, but it will also gain profit from the bigger iron condor. So let's talk about what happens if the price goes between these two iron condors, there's roughly a 30% 30% probability distribution where the price moves outside of this first condor, but still stays within the second condor. So in that case, the first condor may be losing money, but the second condor can start. The effects of the second condor can start to kick in and remaining profitable to potentially cover a part of that loss from the first condor. So essentially, it can act as a hedge for the first condor. So in other words, the biggest strength or advantage of for this type of strategy is hedging. So in layman's term, even if the price moves outside of this first iron condor, the second condor will still be making some profit, acting as a hedge and recover some of the losses from the first condor. Versus if you only place one iron condor here with a theoretical 50-50 chance of profit, once it crosses this condor, you will lose money. But in an 8-legged setup and with two condors, even if you cross the first iron condor, the second condor will still be making some money, which essentially, basically, it's extending your probability of making a profit to 60-40 or 70-30 instead of 50-50 with just a single iron condor. Now, again, these numbers are theoretical. It really depends on how you actually set up this position. Depending on the delta you set up, the premium you're paying, the premium you're collecting. But essentially, that's the idea. Let's summarize a little bit. So if the price does end up in the center here of both iron condors, you'll be making much more profit than if you were just setting up one condor. Now, even if it crosses into these areas outside of the first condor, your second condor will still be making a little money, so you're not losing much versus if you were just holding one iron condor. Now, the last part with the 20% chance of the price crossing both iron condors, that's when a disadvantage of such a position can happen. Of course, you lose a lot more money than if you were just holding one position. So, of course, there's pros and cons in every strategy. But now keep in mind that, remember, a professional trader, institutional traders, when they're setting up this kind of position, they're not just sitting around and waiting for the stock to cross both positions. They're watching it constantly, monitoring it with the bot or with the algorithm. And by the time the price crosses, let's say the first iron condor, they're watching, and based on different factors such as the volume of the day, open interest, call put ratios, you name it, based on monitoring different numbers, different variables, they might be exiting the positions early or adding positions, adding hedging positions, or taking a profit. Yeah, but remember, again, these are theoretical probabilities. The real numbers will highly depend on how you set up the actual positions. But that's the concept and the general idea behind this kind of strategy. So if you do want to place an aggressive iron condor position, let's say in layman's term, again, with a 50-50 win rate to collect premium. So statistically, that means that there's a 50% chance of staying within the condor and 50% chance of breaching it, going outside the condor. In that case, you could set up this type of eight-legged strategy where you add some protection with an 80% chance of the price staying within the whole thing, 50% of staying within both condors, making big money, 80% of the price staying within the second larger iron condor, so that you don't lose as much versus if you were just holding one iron condor, and just a 20% chance of the price breaching and going outside of both iron condors. And you can be actively monitoring this position to make sure that 20% chance of losing the trade catastrophically doesn't happen. And if you set up this type of this type of position correctly, you can really set up the trade so that it works towards your favor. Yeah, I hope that's interesting. I hope that's helpful. Again, this is just one position here, so it doesn't mean that the market is saying that Google will stay sideways in the next few weeks. This is just one aggressive bet. But yeah, I hope the video is helpful. Thank you for watching, and if you have any feedbacks, please leave it in the comment section. If there's some other strategies that you would like to see more in the future videos, let me know. Thank you for watching.